Hi, everybody. My name is Jackson Pino. Like Ann said, I am the Policy and Research Specialist here at MAR, and I am substituting in for our own data guru, David Arbit, who is on paternity leave for the next few weeks. David and his wife just welcomed in twins last week, and everything went great. They are resting and, spending time with their newborns. Happy for them, and I'm happy that I'm here with all of you. Like Ann said, I'm going to be giving roughly a 50-minute presentation today. For those of you who have been part of the monthly webinars before, it will be very similar to what you've seen with David, a few things added in. And I do want to make sure that we have time for questions. There are three major sections of this webinar. I'm going to stop at each of them and read the questions that you have in the chat. So feel free to ask questions either through the Q&A button or the chat. I'll be looking at both, and we can hop right in right now. The June 2021 MAR webinar. Most of this data is going to be as recent as we can get. That means monthly data through May, as well as last week's data on a weekly basis. One caveat to that is because the late spring of 2020 was what it was with COVID-19, we are going to be comparing a lot of that data to a control week or control month of 2019. Not ideal. We plan to go back to comparing this year to previous year when that makes sense. But for this webinar, most of what you're going to be looking at is 2021 data compared to 2019, so keep that in mind. And this is a great quote that David and I always like to start off with. We're drowning in information while starving for wisdom, right? There is no shortage of data out there, and knowing how to look at that data, why it's important, and how to use it in your jobs is really important. And that's kind of the point of this. We want to make sure that we're not just giving you the information, we're giving it to you in a way that you can really understand and deliver that information onto your clients. The agenda for today is mostly in three parts. Short and long-term market trends, market segmentation in particular areas that we think are relevant for you to look at, as well as, if we have time, both local market updates and the tool there on our website, as well as exploring InfoSparks. And we'll be asking and answering questions along the way, but if we have any time left over, I'll open up so that way people can ask questions to me directly if they want to save them till the end as well. Three trends that I want sure that we just get off the table right now. You have it locked in your brain and you can walk away with it knowing you're confident in these three main points. Buyer activity is strong. 2020 was record breaking, like we have talked about in terms of pending sales and closed sales. The demand is really high. 2021 is expected to surpass last year's record. So please keep that in mind as we're going on throughout this. On the other hand, seller activity is relatively weak. They haven't budged much since 2020, like it says here, up 0.1% compared to 2019. And so far, our metrics show that there hasn't been much change from that. So while it hasn't dropped considerably compared to 2019, it hasn't really increased, which leaves for tension between those two forces, between buyer activity and seller activity. Inventory is by far the biggest factor holding back these sales, and like it says, frustrating buyers. Active listings have declined 80% since 2010, and sales have increased, and so has the population. We need to keep those things in mind, the greater market dynamics when we're looking at these charts. So, short-term trends. When I mean short-term trends, I'm thinking of three basic factors here. Showing activity, kind of a precursor for demand. What are people interested in? What are they looking at? Then the demand itself through pending sales. And then supply. in terms of new listings, seller activity. Daily showing activity is compiled by me every week, and this is a trend of throughout a calendar year. How have we performed? We have showing activity, for the most part, a good portion of the year so far, that has exceeded showing activity in previous years. Certainly larger than people who are willing to go out and visit open houses in 2020, as you see in that dark gray dip, but even above 2019 levels, that lighter gray bar across the midpoint of the chart. That teal line is where we're at right now. We did take a dip through Memorial Day weekend. We do that every year. And yes, it was more drastic than it was in the previous 2 years, but we did have a recovery and a slight decline afterwards. I'm excited to see where this will move as the summer progresses, because as you see in 2020, we had a rebound. And it would be exciting to see where that ends up as we come into the late summer. But so far, generally, we have been above previous years in terms of showing activity performance. How much above? Well, you can see by this bar chart, breaks down that line that I showed you in the previous slide by price points. Price points back in 2019, those teal bars, had very much a triangle shape. The listings that saw the most activity were the ones at the lowest price points, specifically $200,000 and below. Not so much now in 2021. We're starting to see a shift in those gray bars that is centering somewhere around $250,000 price point. Now, there could be a lot of reasons for this, and this is only looking at 1 week in particular compared to another week 2 years ago. But late spring, summer's getting better, and the new listings that we're looking at, which we'll see in more detail later, are going down. So part of it is the lack of supply in those lower valued price points, but some of it might be in the fact that there are some tools that are available, particularly in terms of interest rates, that are able to make the dollar of the buyer stretch further. Interesting perspective to look at, but sometimes the absolute values of these numbers can kind of get in the way, right? Let's talk about market share. Now, when I mean market share, let's take a step back and talk about what does a share mean. When I mean share, I mean like this pie, for instance. The part that I have eaten is my share. The part that I have not yet eaten, it could still be my share because it could be just my pie, right? But if I'm sharing it with other people, then that empty space right there is my share. So think about that as we move back into housing economics and talk about the share of overall showing activity. Applying these shares, percentage of the whole, to the housing market with the same data that we were just looking at, you can see, like we mentioned, homes under $200,000 were 28, close to 29% of the overall share of showing activity. That's significant, right? It's dropped. Like we said, part of that could be because of a decrease in supply. Part of that could be a change in taste. But now we are seeing that not only has that shift gone up, but the share is a lot more spread out. It's not that high peak that you see in the teal bars, but it seems as though the gray bars are shared a little bit more equally between 200,000 and about 400,000. How have these changed over time? Now, this chart here just looks at the share and compared to different price points, right? Now we're looking at the gaps between the teal line, the teal bar and the gray bar for particular price points. And that is essentially what this showing activity chart is. Overall, showing activity is marginally down, about 7%, but not everywhere, not at every price point. Particularly in areas $300,000 and above, we are up. In some price points, dramatically up. That $500,000 to $800,000 range is pretty large, which shows, in a larger viewpoint, that people are more eager to get out there, expose themselves to potentially higher price points, or looking at that $300,000 all the way up to luxury homes more than they have in 2019. Let's go over to the supply side of that conversation now in new listings. Just so that way, I'm going to be showing you a lot of charts, so I've tried to simplify this for everybody. If you see purple, for the most part, that's supply. If you see blue, for the most part, that's going to be demand. So that way you can keep that sort of theme going in your head for the next few slides. So purple, we're talking about supply, seller activity, new listings into the marketplace. Over the calendar year, that darkest bar that we have right there, let's see if I can make a pointer options, laser pen. Okay. You can see this darkest line right here. That is this year. We have had mixed results compared to 2019. Sometimes for a few days we'll be above. For the most part, we're still lagging behind. Not as bad as we were in 2020, but still we're not quite up there yet. And after our seasonal Memorial Day dip, we haven't quite recovered back up to where we would like to be in terms of supply. The change in those new listings, since we were just talking about change, is not as pretty of a picture overall. Down 24.6% in last week's results compared to the same week 2 years ago. And pretty much across the board, we are down by particular price points. Particularly for those below $250,000, we're seeing 60% decrease, 62% decrease for these price points. That is definitely perpetuating some of that shift in taste as well. Looking over at pending sales, again, we're in blue. Buyer activity, the demand side of that equation. The darkest line, again, is the most recent data that we have of 2021. And until we got to the Memorial Day seasonal dip that we normally have, we were generally exceeding not just 2020 and 2019, 2018 as well. It is looking like if this trend keeps up and we bounce back for the rest of the year, we're going to see record-breaking pending sales, record-breaking buyer activity. Definitely pulling on the tension of the fact that we don't have as much supply as the market demands right now. Change in those pending sales by particular price points is not overall up. For this past week, we were down again, Memorial Week slump, but this is a general week by week representation of what we're seeing on the demand side of that market equation. Sellers are across the board down, right? Not for buyers. For buyers roughly above $250,000, it is significantly up, whereas below that price point, we are down. That is again pointing to that trend of changing taste towards that $350,000 and above. We're going to talk about, I know there's an elephant in the room here about the increase of luxury home prices. We will get to that, I promise. I want to make sure that we understand what these percentage points mean. But in the meantime, if you want to look at this on a week-by-week basis, please go to our website in the market data section. You can always click on Stats Deck. I usually have this posted by noon every Monday. You can get a nice little paragraph that I write to give you my interpretation of these charts, and you can look at the charts themselves every week. Please go ahead and look at those. Let's take a look at the long-term trends. And by long-term, I mean on a month-to-month view of what happened in May overall. Keep in mind, this is going to be pretty similar. New listings will be down or level, and pending sales will be up, and particularly in the higher price points. But it's good to know that this isn't just a one-off between one week and another, but at a bigger picture, it's happening as well. Let's take a look at purple seller activity, change in new listings. For the month of May, it was not as bad as just the previous week. Yes, overall, we're about 19% down across the seller activity general new listings. But by price point, it's not all doom and gloom. We do have those higher price points that are trying to meet the demand that is being expressed in the marketplace, particularly $500,000 listings and above. We still are struggling to meet supply in those more affordable price points. For the month of May, particularly, it was 150,000 to almost 200,000. But generally, we are down in those more affordable homes. Let's take a look at this and how it compares to previous Mays, all the way back to 2003. This bar represents the number of new listings for each May of each year and how they compare. And as you can see, particularly for the middle part of this, we were at a pretty standard, consistently increasing, yet not very dramatic, increase in supply. Obviously, we have the bubble of 2006, 2007 that crashed, and we had to recover back from it. But it looked like we were definitely having a very sustainable increase in supply. Great to see that. Unfortunately, 2020 came and we had a shift in the market. People were not willing to put up their homes for sale. They felt stability in just staying where they're at. And I think what you're seeing so far is similar. We haven't seen that shift back into the 2014 to 2019 sort of practice on the seller activity. They still seem to be reluctant to put their home on the market. Pending sales, that demand side of the equation for the month of May is marginally up, relatively level, but definitely up for those higher price points and down for the lower ones. Very similar picture, right? Let's take a look at this of May's pending sales over time. And as you can see, we had a that bubble in 2005, 2006, and then the recession, recovery from it, and a more dramatic increase, particularly in the earlier years, than what we were seeing on the seller side of this balance, right? It was fluctuating up and down for the tail end of that level and sustainable increase in seller activity. And then we had a dip in pending sales because of COVID. But unlike the seller activity side of this balance, boy, has there been demand that has just bounced right back. 15% increase. We have not seen a 15% increase since what, 2015? Here with the 19% increase, we were, recovering out of the tail end of our recovery and starting to get back into the swing of things. And we're right back in it, but we're not seeing the same type of activity on the seller side, right? A note here for those of you who might be watching this for the first time: why are we using pending sales, not closed sales? Pending sales is a step in the process, and closed sales are the final part of that step, right? We think that pending sales is a great leading indicator for closed sales, but there are some differences, right? Particularly notice the dip that we have here in 2020, and how there is still the dip, in closed sales, but we have not fully recovered in terms of closed sales yet. Now, part of this, if you were watching our housing webinar last month, you might remember that it takes some time for these numbers to get to us. So when it comes to closed sales, we're still talking about, pending sales and signed purchase agreements that may have happened earlier in the year and they closed towards May, maybe even just the beginning of May, right? And that is one of the reasons why we like to focus on pending sales on this type of equation, if you will, because there isn't as much of that lag time. We do like to look at this, not just exclusively looking at seller activity and exclusively looking at buyer activity. It paints a great picture when you can look at them at the same time. Same concept here. That light purple is the supply side. The dark blue is the demand side. And you can see for particular price points, sometimes demand and supply changes between 2019 and 2021 are similar. Not when it comes to the higher price points. We are seeing the demand far outpace the supply. Definitely an opportunity in the market for the sellers of these 350 plus homes to meet that demand and sell their home quickly, frankly. How quickly? We look to cumulative days on market. Back in 2008 to 2011, we had a lot longer time to sell homes. We started to hit a more balanced stride as we were getting into 2013, 2014, give or take 6 weeks or so, maybe a month. But as we have increased our demand without necessarily increasing supply as drastically, days on market have dropped. And since 2021 and that major imbalance between supply and demand, and now we're selling half of our homes, or we're at least having them off the market in a week. That's crazy. And it's definitely something that we haven't seen since at least 2011. Keep that in mind when you are talking to your clients about how fast-paced the market is. I'm sure you're already seeing it, at your own individual level, but this is that bigger picture. It's not just you, it's everybody. And what is that doing when we have such high demand? It's not just a short shelf life for your listings, but prices are driving up. Again, historically, we see that bubble, we see the dip, we see the recovery, and we have not stopped. In fact, for this year, the 16% increase of May for a median sales price across the Twin Cities, that is the largest increase that you see on this chart. And that just shows how strong of a seller's market we have right now. Let's take a look at a different way of seeing sales price, particularly that change in sales price. This is a chart of year-over-year change of the median sales price, same metrics we're talking about, but instead of talking about the number itself and where it is compared to years ago, we're talking about the change of that number. How much has it increased? How much has it decreased? When you look back to the pre-recession era, we do have, give or take 10% less than as we were going into the recession, but we never really exceeded 10%, post 2004. We obviously had the market crash. We had a tax credit period for a short period of time. That ended, and we still had to recover out of the economic recession. And as we were booming out of that, we had a natural elasticity, if you will, and there were increases in the median sales price for the Twin Cities. That has since leveled off, and we were below, maybe every once in a while peaking above 10%. And then as you get into 2020, it was consistently at or above 10%, particularly for the 2 months in 2021, we were at 16.6%. And this undisclosed little number here is where we're at so far in June. But as you can see, we've had that shift in terms of median sales price increasing at a more regular rate than you have in the previous chunk of time after we recovered from the recession. It's not, remember, we're talking about rate of change here. How much has it increased from one month to another? Let's talk about median sales price, because I'm sure there are some people who have seen this before, but I want to make sure that everybody understands it. There's a difference between a median and an average. And we're going to use Jeff Bezos to understand this. This is one of David's favorite jokes, by the way, so we need to make sure that there's at least laughter in the chat so I can share it with him later. Jeff Bezos walks into a bar. There are 6 people previously in that bar, all with the current list of annual incomes, let's say. Jeff walks in and he's got, roughly $200 billion. What does that mean for the average income in this group of 7? What does it mean for the median income in this group of 7? The average explodes to $28.6 billion. The median, however, is $65,000. Why? It's because the way in which you come up with these numbers is mathematically different. When it's the average, you add them all up, you divide by, in this case, 7, the number of people that there are, which means one person can have a dramatic impact on an average, Jeff in this instance. Median, on the other hand, takes that first group, takes a second group, and finds the person in between those 2 groups. The way we define those groups is by counting from the outside in this instance. Half of the people are below the 50th percentile, the other half of the people are above the 50th percentile. And that person in the middle, person number 4 in this instance, represents the median number. Why is this important? Why are we even talking about this? Let's talk about it in terms of housing, right? Same sort of example right here. We have 6 listings at certain price points, and we have a average sales price of $833,000. We have a median sales price of $312,500. Those 2 numbers represent dramatically different things to your clients, right? Now, we only had 1 out of 5 records, or 20% of all units above the average, this $800,000. Do you think the $800,000 average is representative of this group overall? I don't think so. That's why we use median, because in the same way in the bar example, we took 2 particular groups. We're doing the same thing here. We're taking a group, the first group representing the first half, the lower half of our list here, and then we're taking a second group, the higher half of our list. Now, we have an even number here. What do we do when we have an even number in this list? We take the midpoint between the 2 bordering numbers in our group, which is why we hit $312,500. But I think median sales price represents both of these groups overall, collectively, better than $833,000 does. Quick aside, but that's important for us to understand. Let's think about another way in which we can get a good understanding of how to compare differences in listings, right? Some of you might work more exclusively with condos or small sized homes. Some of you might be in an area that is a lot bigger and they have more room to spread out. But it's kind of like comparing apples to oranges in that sense, right? A way to narrow that down and have a better way of comparing, sometimes still different, but a little bit easier, is by price per square foot, obviously. And that is something that we should be looking at as well, alongside median sales price. And as you can see, it imitates that median sales price shape overall. We have the bubble, we have the recession, and we have the growth. And we also have the significant growth between last year and this year in terms of May median price per square foot. Another way of looking at this would be percent of original list price. This is talking about the, now this is different. I want to make sure we're talking about the right type of math here. This is averages. So we are summing up all the percent of original list price and dividing it by the number of homes that were sold here, not the median. But we do so that way you can see that there are people who are offering above asking price at a more significant level than we have in previous years. We were hovering right around, 100% for the past 3 years, but in the increase in demand from 2021, we are seeing, a 4% increase above asking price. And, that is, it's starting to become a trend here, and it's showing that there is an imbalance between what is available and how many people want to put an offer out on what is available. Inventory, talking about what's available, right? We have seen decreased inventory for a while now, but in the last year, we have seen a greater, or I would just say a more noticeable decrease than we have in recent years. Back in 2008, 2009, the height of that bubble, 36,000 listings in our inventory. We're way down, 5,000, and it's almost, ballpark figures here, half of what it was in 2020. A quick methodology note here for you, because I know some people have asked for this. Remember days on market, we were talking about how the shelf life for listings is so low. We need to remember that the way in which I calculate this number is like looking at a snapshot on the very last day of a month. We look at the listings that are under active status for that last day. And we know that this doesn't show all of the options that are available to your clients. Why? Because of the short shelf life of the listings on the marketplace. 7 days, that means that, if there's a home that's put on the market on, let's say, May 5th, there's a 50% chance it's going to be off in 7 days. So it's never going to reach to the end of the month to be captured in this number. So just keep that in mind as well. That there are other available options that you're going to see discreetly within the week, within the month, that aren't necessarily captured here. But overall, you are seeing that it is a decreasing trend in inventory, and it's been noticeable, right? Another way of looking at that, and I think this is a great thing to understand not only for yourself but for your clients, is month supply of inventory and absorption rate. And if this is a new concept to you, I really like the analogy of how far can I get on my current tank of gas in my car if I stop going to the gas station? i.e., if we stop having homes coming into the marketplace, how long is our current inventory going to last? It used to be that we were in what I would call a more balanced market, 2012, 2013, 14 area, of about 4 or 5 months supply of inventory. this has steadily been decreasing, and we are now at 1 month supply of inventory. That means that if we just stopped, entering new homes onto MLS, people stopped selling their homes, the current inventory would be gone in a month. That's wild, right? And how do we determine whether or not it's a seller's market, a buyer's market? It's a good thing, a bad thing? Because some people might be thinking, yeah, homes are hot right now, like this is great, right? Not necessarily. We need to understand the sustainable aspect of this. So seller's market. Right now, we are in a very strong seller's market. There are many people who want to buy a very few number of homes. A buyer's market would be the exact opposite of that. We would have many homes that are available to a relatively fewer number of people interested in buying them. A balanced market is ideally there are roughly an equal number of interested buyers for sellers that are currently on the marketplace. We have an understanding that the balanced market is sustainable. It will last longer because that equilibrium is reached between the two groups, right? That mathematically comes out to about, I would say, 4 to 6 months supply of inventory overall. And we are now currently well below 5 months supply of inventory. So keep that in mind in the bigger picture of things. We want to make sure we're closer to here in the long term. This means that there, a very constant, continuous flow of buyers and sellers that are regularly coming to our places of business and helping them, get rid of their homes and buy new ones or buy new homes for the first time. Let's talk about affordability. I know we have about 20 minutes left. I will pull open the chat. I see that there are 2 questions both in the chat as well as Q&A before we move into the more affordability side of things. Oh, thank you, Pat, for acknowledging the work of our slide deck that we have. I appreciate that. Q&A. Joe asks, what is the change in each slide? Change in the number of listings. So Joe, I believe you are talking about some of those earlier slides that I was showing where the change of new listings or the change of pending sales. We're taking a look at the actual number of, let's say, new listings, for instance. Let's say it was 5,000, right? New homes that are put on a marketplace in May. If we say the next month, in June, it's 10,000 homes have been listed on the marketplace. The change between 1 month and the next month is just as interesting as the actual number overall, because that change is telling us, the direction in which things might be going in the future, hopefully. I hope that's helpful. Feel free to post a follow-up question or say in the chat if it's still confusing. We also have another question. Since you're using pending sales, what is the margin of pending sales that don't close? That is a great question. I don't have the particular answer for you right now, but this is a great opportunity for me to plug office hours. Friday at 1 p.m., I will be hosting office hours where I will answer this question. We will take a look at it, and we'll kind of explore that idea. My assumption for the most part is that it's not very high that pending sales don't close. Not saying it doesn't exist, as you guys know, it does, but probably not high enough for me and David to say pending sales isn't really a good indicator for us. But we can look into that if you want. Yeah. I'll share the link in the chat for office hours if that's of interest to anyone at the end. Okay, let's head on in and talk about affordability. Okay, we are going to be, as David would say, diving deeper with Scuba Sam and Respirator Rachel. Gotta love David's jokes, right? So this is a chart of the percentage of listings priced under $250,000. It's an average of the 12 months for each month. And it shows an interesting story here that ideally, let's take a step away from looking at this graph of the lines. Ideally, if every home was under $200,000, you would see a line all the way up at the top. Well, it would be above 90%. It would be at 100%, right? And so as the number of homes under 250 decreases, so does the line. You have the recession here because obviously when the market crashed, homes were being listed on the market price for lower values, and that started to dip in below $250,000. And so the share of these, I will say, affordable homes is increasing. We hit a peak at around mid 2011 for each of these regions, mainly the Twin Cities and then the Twin Cities 16 county region overall, but has since declined. We might have some little variation as we go on, but overall we have seen a decrease. Why is this, right? Well, part of it is because of supply. I think that's the most significant factor that we can keep nailing in each of these charts. The lack of supply is impacting almost all of them. But it's impacting them differently, right? You can see here, St. Paul has stayed a little bit more consistent throughout the past year. I know that there's some Minneapolis St. Paul beef. I'm not from here, but I've heard it, and I get that it's real. But we need to admit to ourselves, St. Paul is sustaining a little bit more level this threshold of affordability compared to Minneapolis and the Twin Cities overall. Minneapolis, on the other hand, has started to see a decrease, but has picked it back up in recent months. That's promising, right? But why is there such a difference between either of these cities, but Minneapolis and the rest of the Twin Cities region? That's because you have different luxury homes that are captured in this gray line of the Twin Cities region overall that aren't captured in Minneapolis. Think your Wayzatas, your Edinas, your Prior Lakes, and also I think you can't underestimate it, new construction. There is not a lot of room to build in an already well-established area that is Minneapolis and even St. Paul, whereas there is more room to build. And when you increase the number of homes, and they're, let's face it, not going to be below $250,000, then that share of the homes priced affordably decreases. Historically low rates and rising incomes. This chart looks at two things. Let's assume two things here. A median earner, so a person making a median income, half the people are earning above that person, half the people are earning below that person, is seeking a median priced home. This is the percentage of pre-tax income that median earner would have to spend on a median priced home at the given time across the horizontal axis here. This is important to understand because there is another dynamic, a silver lining, if you will, at play for all of this. That I'm sure some of you are screaming at the computer right now saying, I know what it is, but we'll get to it, right? We look back at the housing bubble you know, and we have roughly 25% of that median earner, they'd have to spend a quarter of their income on a median priced home. We had that recession and the recovery, and although we're at a different point, we don't have a bubble, we have really strong sellers market, we're not seeing the same sort of percentage here. Why? Right? Okay, we'll say it. Mortgage rates. Let's take a look at this, right? Here's another chart that helps explain that just as well. Let's, instead of thinking of it as percentage, let's talk about it in the world that people actually understand it in, monthly payments, right? Same bubble here, you know, a median monthly payment for $1,600, let's say, for a median priced home at that time of $230,000, right? Go through the dip of the recession and the recovery out of it, and we have the same level monthly payment, but look at the price of a home that you're getting for the same monthly payment. $300,000 home compared to $230,000. The dollar of the individual can stretch further. We're obviously assuming a lot of things here. Want to make sure that that's well understood. It doesn't look like this for absolutely everybody, but overall, what this is showing you is that interest rates are historically low and have been stable at around 3% since late April. That's great for your clients who are looking to buy. So that's, you know, let's keep that as the great silver lining of what's going on right now. Thank you, interest rates. Another way to look at this, price to income ratio. Let's take that assumption of family income. Keep in mind, median family income. You might have multiple earners in the household, that sort of thing. And a median priced home at, let's say, $300,000. Back in the bubble era, we had about 3 times your income would be the value of your price overall. We're still seeing that here. Now, this is a barrier for a lot of people, admittedly, right? And this could be leading to a certain level of anxiety when you're talking about, wow, excuse me, 3 times my income. Is that manageable? A lot of people would ask themselves. I think it's important to look at this compared to other cities. And so we've done that here for you. You see Minneapolis, St. Paul, the Twin Cities region in bold, 2.9 or 3 times your income for the price of your house overall. But we're not doing as bad as other people. You know, one lesson that I've learned early on here is whenever you're feeling down, compare yourself to others who have it much worse, right? San Francisco, their incomes, as you can see down here, are like 40% higher, but their median home price is $1.6 million. That's 6 times higher than ours. So that ratio of median home value to median earnings leaves with a price to income ratio of 11.5 times the value of the median income for the median price of a home. Obviously, we're not there yet, and so it's great to, you know, understand, you know, compared to some of these other cities, San Diego, Seattle, Denver, Phoenix, Atlanta, Charlotte, Boston, we're doing okay. Now, obviously, there are some cities I haven't listed here, you know, St. Louis, and a few others that are below us. And so keep that in mind. You know, I'm not saying everything's rosy over here, but, you know, we could be in a deeper hole than we already are in terms of affordability. Another thing that I'm pretty sure is going on in the back of people's minds right now is, well, could this be a bubble? I don't think so, and I'll explain why. This is a great way to visualize a bubble, right? I'm going to show you two charts that are great ways to look at it. First, in terms of price. Twin Cities overall median sales price, or sorry, average sales price in this instance over time. And this blue dotted line shows you the trend. This curve, these two curves right here, are showing you annual appreciation and year-over-year appreciation. Basically, the average growth of sales price over time. I think it's a nice way to kind of say, what is a sustainable curve? What's it going to look like given stable market conditions that consistently grow over time? And as you can see in the 2005, 2006, 2007, we were above that. That was our bubble. We were not in this channel here. When we recovered, we had to be below it for some time. And in fact, we are still below it. I think there's room to grow here. And as long as we're in and around this area, I don't think you can confidently say that we're in a bubble. It's more of a shift in the marketplace. The market dynamics are more natural and therefore more stable, and therefore need some pushing, to change, either by increasing supply or having demand fall. The other way of looking at this is just looking at closed sales versus new listings, and as you can see, we had the definition of a bubble, right, is looking at the difference between the supply and the demand, where it is at and where it isn't, right? And the 2005, 2006, 2007 sort of area, you can see that major gap, particularly in the trend lines. If you want to look at these tiny little dotted trend lines, you can see that there is a noticeable difference between what's going on here on the supply and the demand side of the equation. But as we creep towards 2021, it's not there, right? We don't have that bubble from an economic standpoint. So it's not something that I think is going to crash anytime soon. We will probably have a market correction, but a market correction is different than a bubble pop. Now, another thing that I think people have often been talking about, and I know we only have 5 minutes left, is urban market share. The idea that people are leaving the urban part of the Twin Cities and they're going off to more rural areas. I want to let you know from my perspective that we did have a downwards trend for the early part of 2020, as you can see right here, but in recent months, we've increased again, and I think that that is showing the exact opposite. Part of the reason why, and then we'll get into something that I teased at the very beginning of this, luxury homes. You've probably seen it a lot in the news. Luxury homes. They are catching headlines everywhere. Why? It's because increases. And I want to explain something here before we talk about luxury homes and its increase. There is some understanding of statistics that's really important here. And of course, we got to talk about Twins baseball, right? Target Field opens, Twins baseball, stage 1, 24,000 fans are allowed. Not everybody, just enough. Now, when you have stage 2 come in and everybody's allowed in, you have a difference. We've talked about these differences in housing, right? But it's good to understand that differences matter, if that makes sense. The difference between stage 1 of Target Field and stage 2 is a 66% increase. Okay, impressive, 66%. Compare that to a different size group, a really small group, David's family. And they love the Twins baseball because it was just David and his wife, but now they have twins. So all 4 of them are the fans of the Twins. Now, if you go from stage 1 of David's family to stage 2 of David's family, that's a 100% increase. Well, isn't that a lot more impressive than the 66% increase that was in Target Stadium? I argue doubling a group of 2 to 4 is not as impressive as a not necessarily doubling from 24,000 to 40,000. So keep that in mind as we talk about close sales above 1 million. These are all really small numbers, is what I'm trying to get at here. Small compared to the thousands of homes that are in the marketplace today. Yes, we have seen increases in recent years. We saw a dramatic, and I'll be happy to say dramatic, decrease percentage-wise. We also saw, again, a dramatic increase coming out in 2021. But just because you're seeing a almost 240% increase from a dip to a rise does not mean that it needs to get on the headlines all the time. But it's good to know that it is increasing. And even though it is a small sample size, it's a large part of, dollar value. And it's important to know where it's going. And for those of you who are curious, the percentage increase between 79 and 139 is about 76% increase. So if you skip over that dip. But it's good to know that there is an upwards trend in the luxury housing market, and you should definitely be aware of it, particularly when you have clients that are interested in that sort of dollar value. Applications. I have 3 minutes left, so we're gonna just talk about applications, and that will be what I have for you today. If you want to explore local market updates in InfoSparks, you can either attend our InfoSparks class that's coming up, or you can ask me particular questions during office hours, which again, I'll post in the chat. So how do you use this stuff as a realtor? Why should you care, right? Because information is power. Everything you're learning here today can be directly informative for your clients. So please, when you hear questions like what you see on the screen, is it a buyer or a seller's market? How do property types compare? Are prices going up and down? How long will it take me to sell my house? So on and so forth. You can see there are direct charts or statistics or little graphs that I can show you to give you the answer for each of these types of questions. And it's up to you to be your own expert to help motivate your own business forward, right? You will benefit from this not only just for open housings and your own presentations, but you become a better realtor because of it. You grow your network. You can manage the expectations in a tense marketplace. And we all know that it's really tense right now. So giving your client that reassurance is worth its weight in gold, right? You can have rough forecasting. You can show some growth opportunities, stuff that we've already talked about here, and you can get down to not just the Twin Cities overall, but specific areas. I am going to have to stop now because we are at time. Thank you all. My email is right there. I'm going to take a moment to, I'm going to stop screen sharing. I'm going to go find that link, and anyone who is interested is more than welcome to join me in office hours between 1 and 2 tomorrow.
Jackson, I did already add it in the chat. So
oh, great.
Yeah, it looks like there was a couple questions that came through, one in the chat, one in the Q&A. If you wanted to. Yeah,
Bill, guessing on the time that you asked that question, it's median household income. The $100,000 unit was median household. I remember catching myself on the second slide of that, but just in case you didn't hear it, yes, it is the household income, not an individual. And then in the chat, I see in reverse order, Catherine, can you talk more about market correction? What does that look like? Well, there are, we call them the 5 L's, and forgive me if I don't remember all of them because it was not in my head for the presentation, but it is labor, lumber, lots, oh, I know I'm missing one, and laws. But basically, there are some like fundamental resources that are needed to help reach an equilibrium between supply and demand. And those factors need to change in some sort of way for that shift in the market to occur. A simple way of looking at it in a big picture is if we have more development in homes, then overall you will have more supply. And because of that, the price will go down. I hope that helps. It was very broad brushstroke there, but I hope that helps kind of get an understanding of what I'm talking about in terms of market correction. All right, everybody, thank you so much. I really appreciate you coming in and joining the presentation, and I will see you all next time.